The last time this happened was 1980. The rules were changed. Buying was banned, silver trading was placed into liquidation only. You could sell, but you were no longer allowed to buy. 45 years later, the same regulator has just called an emergency close meeting on silver market stability. Emergency authority does not exist to calm markets. It exists for one reason only: when contracts can no longer be enforced without breaking the system. That specific alignment of history and current events is not a coincidence, nor is it a matter of mere administrative routine, even if the bureaucratic language employed suggests otherwise. A notice recently appeared on the website of the federal regulator, posted quietly after the market close in a section most investors never read, written in the flat, uninspiring language of compliance. It did not lead the evening news, and it did not move markets on the day it was released, but for those who understand how financial systems actually break, the meaning was unmistakable. The Commodity Futures Trading Commission announced that it would convene an emergency close meeting to address market stability in the precious metals complex. The specific terms used, closed session, emergency authority, market integrity, are not descriptive phrases. They are preparatory ones. They are the linguistic tools utilized when a regulator believes that the normal rules of engagement can no longer contain the consequences of existing positions. In the landscape of modern American finance, emergency meetings are not debates where outcomes are decided. They are acknowledgments of outcomes that have already been modeled. They signal that risks have been quantified and that institutional exposure has crossed a critical threshold that cannot be allowed to resolve on its own. When regulators move behind closed doors, it is because the open market is about to be overridden. To fully grasp the gravity of this moment, it is necessary to be precise about what the CFTC is, and perhaps more importantly, what it is not. The Commission does not exist to set prices or allocate resources. Officially, its mandate is to ensure orderly markets, prevent fraud, and maintain confidence in the futures system. However, unofficially, its mandate has always included a secondary function that is rarely stated aloud: preventing losses at the core of the financial system from cascading into institutional failure. This function only becomes visible at moments of extreme stress because futures markets are not neutral arenas. They are leverage engines. They allow enormous notional exposure to be built on relatively small amounts of capital. When markets move slowly, this leverage amplifies returns, but when markets move abruptly, leverage concentrates losses. The CFTC exists in part to ensure that when these losses accumulate, they do not do so in ways that threaten clearing members, banks, or the settlement infrastructure itself. That is the sole reason emergency powers exist. Under the Commodity Exchange Act, the Commission has broad authority to act when it determines that an emergency threatens orderly trading. The law does not define an emergency in quantitative terms. It does not specify price thresholds, volatility bands, or inventory ratios, but rather leaves the determination to the discretion of the regulator. This discretion is intentional, allowing the Commission to act before the market resolves imbalances through the price alone. Historically, these powers are not used to protect retail participants from losses. Markets are allowed to fall, and prices are allowed to collapse. What is not allowed is for the mechanism of settlement to fail. When a regulator calls an emergency meeting about market stability, it is not reacting to speculation. It is reacting to structure. It is reacting to the distribution of positions across institutions, to delivery obligations that cannot be met under current rules, and to the risk that enforcing contracts as written would produce outcomes the system cannot absorb. This distinction implies that the current situation is not a story about enthusiasm for a metal, but a story about obligations embedded in paper markets that are increasingly misaligned with physical reality. The reason the recent notice resonated so strongly with those who have studied this market is simple. This exact sequence has occurred before. It did not happen metaphorically or approximately. It happened procedurally. In the late 1970s, inflation eroded confidence in the dollar, and real interest rates turned negative. Capital moved out of cash and into tangible assets, and among those assets was silver, not merely as a speculative trade, but as a hedge against monetary debasement. Demand increased not only for futures exposure, but for the physical metal itself. Simultaneously, banks and dealers had built large short positions in silver futures, positions that were profitable as long as prices remained stable, and few participants demanded delivery. The system relied on rollover. Contracts expired, new contracts were opened, and physical settlement remained marginal. However, that reliance became a massive vulnerability. When buyers began to accumulate both futures and physical metal simultaneously, the gap between paper claims and deliverable supply narrowed. As prices rose, losses on short positions grew, and margin requirements increased. The pressure did not come from speculation alone. It came from the possibility that contracts would be enforced in full. At that point, the system faced a binary choice: allow delivery obligations to be met through the market, forcing shorts to acquire metal at rising prices, or change the rules governing who could buy. The response in 1980 was not to halt trading, but to alter its direction. New long positions were prohibited. Existing longs were permitted to sell, but not to add. This was described as a measure to restore order, but in practice, it ensured that prices could only move one way. That episode is not remembered because of who profited or who lost. It is remembered because it established a precedent. It demonstrated that in moments of structural stress, the futures market is not governed solely by supply and demand, but by regulatory discretion. When observers look at a modern emergency meeting through that lens, they are reacting to memory. The modern silver market is far larger, far more financialized, and far more integrated into global supply chains than it was in 1980. Industrial demand is now structural rather than cyclical. Silver is embedded in electronics, energy systems, medical devices, and manufacturing processes that do not pause when futures prices fluctuate. At the same time, the paper market has expanded far beyond physical throughput, with open interest representing claims many multiples of deliverable inventory. This configuration is stable only as long as most participants treat contracts as financial instruments rather than delivery obligations. When that assumption begins to fail, regulators intervene not to suppress enthusiasm, but to prevent enforcement. The significance of the CFTC notice is not what it says explicitly, but what it implies institutionally. It implies that the existing structure cannot resolve current pressures through price movement alone. It implies that settlement, not valuation, has become the constraint. This is the moment where analysis must slow down. Once emergency authority is invoked, markets no longer reveal information, they enforce outcomes. The question is no longer whether silver is scarce or whether prices should be higher or lower. The question is whether the rules governing who may buy, who must sell, and who may settle will be altered to preserve institutional continuity. This is not a speculative question, but a historical one with a distinct track record. Emergency authority in commodity markets did not emerge accidentally. It was built into the legal framework because lawmakers understood something fundamental about leverage long before most investors did. Futures markets concentrate risk, allowing economic exposure to grow faster than physical supply and faster than the ability of counterparties to absorb losses. In ordinary conditions, leverage improves efficiency, but in stress conditions, it magnifies imbalance. Losses stop being informational and become systemic. The phrase orderly trading is often misunderstood to mean fair outcomes or accurate prices, but it actually means the uninterrupted ability of clearinghouses to settle obligations without cascading default. Clearing is the core. Everything else is secondary. Every futures contract ultimately rests on the assumption that margin, collateral, and default waterfalls are sufficient to absorb losses if positions move against participants. When that assumption is threatened, regulators intervene upstream. They do not wait for insolvency. They change incentives so that positions unwind before settlement fails. That is why emergency interventions target behavior rather than prices. They restrict who may hold exposure, how much leverage is permitted, and which participants must reduce risk first. The language used is neutral, but the effect is not. In 1980, the intervention did not accuse the market of being wrong, it accused the market of being disorderly. That distinction allowed regulators to frame rule changes as technical necessities rather than political decisions, yet the outcome was unmistakable. Losses that would have accrued to heavily short institutions were transferred elsewhere through forced liquidation. The lesson from that episode is that when delivery obligations collide with leverage, the futures market ceases to function as a price discovery mechanism and becomes a risk management problem for the state. That same logic applies today, regardless of asset or narrative, but modern commodity markets are even more vulnerable due to their interconnectivity. Banks are not just traders, they are clearing members, credit providers, and intermediaries. Losses in one segment propagate through balance sheets into others. Regulators do not need a conspiracy to act, they need correlation. When positions concentrate, margin sensitivity increases, and physical settlement becomes more than theoretical. Correlation rises sharply. This brings the discussion to the present structure of the silver market, which differs from 1980 in scale, but not in logic. Today, silver futures represent claims on metal that far exceed the amount readily deliverable through exchange warehouses. This is standard operation for futures markets, where the vast majority of contracts are rolled or settled in cash. However, confidence breaks when participants decide they want metal rather than exposure. Industrial demand has grown steadily, driven by applications that are not easily substituted, while mine supply responds slowly to price because production decisions are capital-intensive and long-dated. This mismatch creates a structural tightness that paper markets smooth over through leverage, but when prices rise into option expiration cycles, margin recalculations, and delivery windows, the system becomes acutely sensitive to timing. Options expiration concentrates obligations. Calls that move into the money require hedging. Market makers adjust delta, and if price continues to rise, gamma accelerates, amplifying movement. Under normal conditions, liquidity absorbs this, but under tight conditions, it exposes who must buy and who cannot. Regulators understand this calendar better than anyone else. They track open interest by strike and model delivery demand. They know which participants are structurally short and which cannot source physical metal without moving prices further. When an emergency meeting is scheduled just ahead of a major expiration, it is not coincidence, it is choreography. The objective is not to stop price movement indefinitely, but to alter the short-term path so that specific obligations that expire out of the money settle in cash or unwind under controlled conditions. This reduces stress on clearing members and prevents a scramble for physical supply that cannot be met without disorderly price escalation. From a regulatory perspective, this is rational. From a market perspective, it is interventionist. Both can be true simultaneously. The critical point is that such actions do not eliminate underlying imbalances, they defer them, moving them across markets, time, or jurisdictions. When buying is restricted in one venue, demand does not vanish, it migrates. It seeks substitutes and expresses itself where rules allow. This is where the distinction between paper and physical markets becomes decisive. Futures exchanges are centralized, regulated, and rule-bound, whereas physical markets are fragmented, global, and governed by contract law, rather than administrative discretion. The CFTC has authority over futures trading in the United States, but it does not control bullion flows in London, Shanghai, or private bilateral transactions. When futures prices are forced down through regulatory constraint, physical buyers do not suddenly perceive abundance, they perceive dislocation. They accelerate procurement elsewhere. This divergence has occurred repeatedly in commodity markets under stress. When one price is constrained by rule and another is not, arbitrage attempts follow. When arbitrage fails due to delivery bottlenecks or legal barriers, prices separate. At that point, the futures price ceases to function as a global reference and becomes a local artifact of regulation. Regulators are often aware of this risk, but accept it as a lesser evil compared to immediate systemic stress. Fragmented pricing is tolerable, clearing failure is not. This trade-off explains why interventions tend to be temporary and framed as stabilizing. The intent is to buy time to allow positions to unwind and restore confidence that obligations will be met without forcing the system to test its limits. Whether that intent succeeds depends on what happens next. If physical supply loosens and demand recedes, the system resets. If not, the divergence widens. Futures markets lose relevance, physical premiums rise, and producers and consumers seek alternative venues. At that stage, intervention has preserved the institution but weakened its function. History suggests that this outcome is more common than regulators prefer to admit. Markets constrained by rule eventually yield price discovery to markets governed by necessity. The purpose of examining this process is not to predict a specific price path, but to understand cause and effect. When emergency powers are invoked, they signal that the market, left alone, would have resolved imbalances in a way deemed unacceptable to the system. The signal is that enforcement of contracts as written has become a problem. Understanding this allows us to interpret what follows with clarity rather than emotion. When regulators intervene to prevent enforcement, they are making a choice about which signals matter and which must be muted. Price is a signal, delivery is a signal, stress within clearing systems is a signal. Emergency action suppresses some signals in order to preserve others. The first response occurs within the futures market itself. Restrictions on buying, increases in margin requirements, or reductions in position limits all work through the same channel. They raise the cost of holding exposure. Participants who are leveraged must either post additional capital or reduce positions. For many, reduction is the only option. Forced selling is not a judgment on valuation, it is a function of balance sheet capacity. This creates downward pressure that appears to confirm the regulator's concern about excess speculation, but in reality, it reflects the withdrawal of leverage. This process is often described publicly as cooling the market, but internally, it is understood as decompressing risk. As prices fall, narratives shift quickly. Media coverage follows price, not structure. A decline becomes evidence that intervention was necessary, and analysts reinterpret fundamentals to fit the new level. Volatility is framed as instability resolved by oversight. The effect on retail participants is predictable. Those without access to institutional capital experience losses first, while those using derivatives experience time decay. Confidence erodes, participation declines, and liquidity thins further. Meanwhile, the institutions whose balance sheets motivated the intervention gain time. Losses are capped and delivery obligations are avoided. Exposure is reduced under regulatory cover rather than market pressure. This asymmetry is not accidental. It is embedded in the design of emergency powers. However, what happens outside the futures market follows a different logic. Industrial consumers do not hedge because they enjoy trading. They hedge because they require input continuity. When futures markets become unreliable as sources of supply, procurement shifts. Contracts are negotiated directly, inventories are drawn down, and alternative suppliers are engaged. In physical markets, restrictions on buying in one jurisdiction often accelerate buying elsewhere. Geographic arbitrage widens, premiums rise, and lead times lengthen. The signal sent by regulatory intervention is not abundance, it is scarcity acknowledged. This is why decoupling occurs. Paper prices respond to rules, while physical prices respond to needs. Over time, producers adapt. If futures prices no longer reflect realizable revenue, producers reduce exposure, sell forward less, and prefer spot contracts. This gradual withdrawal weakens the futures market's claim to price discovery. The market continues to trade, but it trades representations rather than flows. This outcome has precedent. When the gold window was closed in the early 1970s, it was framed as a temporary measure to protect the dollar. Gold trading did not stop, it moved. Offshore markets grew, and price discovery shifted beyond the reach of domestic controls. Similarly, when short selling was restricted during the 2008 financial crisis, it was justified as protecting stability. Yet liquidity fell, and volatility increased. Each of these episodes shares a common feature. Regulation delayed adjustment, but did not eliminate imbalance. In commodity markets, the cost of this delay often appears as fragmentation. Multiple prices emerge for the same material. Trust in benchmarks erodes, and long-term contracts are renegotiated. The silver market is particularly sensitive to this dynamic because it straddles the worlds of monetary metal and industrial input. Its paper market is deep, but its physical supply is finite and slow to adjust. When stress appears, it cannot be resolved quickly through production. That is why timing matters so much, and why regulators intervene at critical nodes like options expiration. Understanding this allows us to interpret intervention not as an endpoint, but as a phase. The immediate effect may be a price decline, but the medium-term effect may be divergence, and the long-term effect is often structural change. Markets adapt. Participants learn where risk truly resides. If intervention successfully restores confidence and physical supply loosens, the system normalizes. If not, the paper market's role diminishes incrementally. None of this requires malice or conspiracy. It requires only incentives aligned towards stability and a system built on leverage. When emergency powers are invoked, they tell us that leverage has reached a point where enforcing contracts would produce unacceptable outcomes. That information is more valuable than any forecast. It tells us that price alone cannot resolve the imbalance and that the architecture is being stressed. The rest of the story unfolds according to how participants respond to that signal. Do they accept paper representations at face value, or do they seek control over supply? Do producers continue to trust benchmarks, or do they negotiate outside them? These decisions shape the market far more than any single regulatory announcement. In that sense, intervention is not the end of a cycle, it is the moment when the cycle becomes visible. Visibility changes behavior. Once participants understand that a market is being managed rather than discovered, their incentives shift in subtle but durable ways. Trust becomes conditional, and exposure becomes tactical rather than strategic. This is especially true for producers and large consumers whose planning horizons extend beyond quarterly price movements. For them, the central question is whether the market will remain a credible mechanism for allocating supply. When credibility erodes, contracts change. Producers reduce forward commitments and seek counterparties who can take metal, not just exposure. Consumers respond by diversifying sourcing and building inventories, transmitting a different signal than futures prices convey. This divergence creates a feedback loop. As physical premiums rise, the gap between paper and physical becomes harder to ignore. Arbitrage that once smoothed markets fails because delivery constraints or regulatory barriers prevent alignment. At that stage, the futures market becomes increasingly insular, trading financial risk among participants whose primary objective is risk transfer, not delivery. That market can persist for a long time, but its relevance to the underlying commodity diminishes. Regulators are aware of this risk, but their tools are limited to their jurisdiction. They cannot compel global alignment. This brings the discussion to the role of international markets, which often become the release valve when domestic constraints tighten. Silver moves through London vaults, Asian exchanges, and private contracts that operate on different legal foundations. When one venue imposes restrictions, activity migrates to others. This migration appears first in premiums, then in inventory movements, then in trade flows. Over time, pricing authority shifts. History shows that when pricing authority shifts, it rarely returns fully. The London gold market emerged in part because domestic controls in the United States constrained price discovery. Offshore dollar markets developed because capital controls distorted onshore pricing. Each intervention intended to preserve stability created incentives for parallel systems. In commodity markets, these parallel systems are often more resilient because they are closer to physical reality, relying on trust, collateral, and delivery rather than leverage and margin. The important question is not whether intervention will succeed in the short term. It often does, as volatility falls and prices retreat, but what information the intervention reveals. It reveals that price levels were not the problem, structure was. It reveals that the system prioritizes continuity of intermediaries over the neutrality of rules. This prioritization is a feature of modern financial governance, from central banks to treasuries. They act to prevent cascading failure, even if doing so distorts signals temporarily. When the hierarchy is revealed, participants adapt. Some reduce exposure, some shift venues, and some exit entirely. Over time, these choices reshape markets. If physical demand remains strong and supply remains constrained, interventions become more frequent and less effective. Each one addresses the immediate pressure, but leaves the underlying imbalance intact. Eventually, the cost of distortion exceeds the benefit of stability, and reform becomes unavoidable. Benchmarks are redefined, and markets consolidate or fragment. This is how financial architecture evolves, not through design, but through stress. The silver market today sits at a familiar inflection point, exhibiting the characteristics that have preceded change before: high leverage relative to physical supply, concentrated positions, rising industrial demand, and regulatory attention timed to critical settlement windows. These elements indicate sensitivity, telling analysts where small changes can have large effects. In either case, the invocation of emergency authority marks a transition. The market moves from one regime to another. The question is which regime follows. Will the futures market remain the dominant mechanism for pricing and allocation, or will its role narrow? Will physical premiums normalize, or will they embed permanently? These outcomes depend less on regulatory intent than on participant response. Markets are adaptive systems that absorb rules and adjust behavior. Interventions that ignore this adaptability often produce unintended consequences. This is why studying history matters, not to repeat slogans, but to recognize patterns. In 1980, the immediate objective was achieved, the crisis was contained, and institutions survived, but the silver market rebuilt itself on different terms. Similar lessons followed interventions in other asset classes. You can influence markets temporarily, but you cannot command them indefinitely. That principle is structural, not ideological. As we consider the present moment, the signal lies in the willingness of authorities to alter rules to prevent enforcement. That willingness tells us that the system is operating near its tolerance limits. What happens next will not be decided by speeches or press releases. It will be decided by flows, by where metal moves, by who accepts which prices, and by which contracts are honored. These decisions will determine whether intervention restores equilibrium or accelerates transition. In the end, markets do not respond to authority, they respond to incentives. Emergency powers change incentives temporarily, physical reality changes them permanently. Recognizing the difference is the essence of analysis. At this stage, the distinction between temporary stabilization and structural resolution becomes unavoidable. Markets can be steadied, but they cannot be persuaded indefinitely. When incentives and constraints diverge for long enough, behavior changes regardless of official intent. This is where historical comparison becomes most useful as pattern recognition. In 1971, closing the gold window was presented as a technical, temporary adjustment. It did not eliminate the imbalance, it removed the mechanism through which it was exposed. What followed was not stability, but transition, as gold trading moved offshore and the dollar system adapted on different terms. In 1933, gold confiscation was justified to stop hoarding, but the real objective was monetary flexibility. In 2008, bans on short selling addressed symptoms, not the underlying leverage. In each case, intervention addressed an immediate constraint, but left the deeper imbalance unresolved. Commodity markets respond in similar ways because they sit at the intersection of finance and physical production. They cannot be stabilized purely through regulation if supply and demand are misaligned. Silver occupies a unique position, small enough that leverage matters, but essential enough that substitution is limited. When emergency authority is invoked, it suggests the paper layer has stretched too far from the physical base. The immediate effect may be a repricing downward, but the longer-term effect depends on whether physical flows realign with paper signals. If futures prices fall while physical premiums remain elevated, the message to producers is clear. The futures price no longer reflects realizable value. Participation declines, hedging shrinks, and liquidity thins. This learning process is slow but cumulative. Over time, Markets that repeatedly experience rule changes at critical moments become less attractive for long-term risk management. They remain useful for short-term positioning, but not for planning. This shift affects capital allocation, investment in production, and inventory strategies. From a systemic perspective, this is the trade-off regulators implicitly accept, prioritizing immediate stability over long-term neutrality. The silver market today reflects this tension. It is not in crisis because prices are high. It is under scrutiny because obligations are concentrated and leverage amplifies small imbalances into large risks. Emergency meetings occur because continuation under existing rules is viewed as dangerous. That fact alone provides valuable information. It tells us that an enforcement of contracts, if allowed to proceed without modification, would produce outcomes that exceed institutional tolerance. It tells us that time has become a variable regulators seek to control. What it does not tell us is that scarcity has been eliminated or that physical reality has changed. Those elements operate on longer horizons. As analysts, the discipline is to resist narrative temptation and see intervention as a signal embedded in institutional behavior. The system is adjusting its rules because its assumptions are being tested. How that test resolves will depend on whether adjustment occurs only at the paper level or extends into production. If supply responds and demand moderates, the system stabilizes. If not, pressure accumulates elsewhere, and intervention becomes more frequent, reinforcing the perception that prices are managed. Each episode accelerates adaptation. Markets do not rebel, they reroute. Time, the center of gravity shifts, and pricing authority migrates. This is not dramatic, it is incremental. By the time it becomes obvious, it has already occurred. The present moment, marked by emergency authority and closed meetings, fits the early phase of this process. It is not an endpoint, it is a diagnostic. Understanding that allows participants to see beyond price moves to structural signals, suggesting a system under strain, prioritizing continuity over equilibrium. That is the framework within which the silver market should be understood, now not as a battleground, but as a case study in how modern financial architecture responds when leverage meets physical constraint. What follows will not be decided in a meeting room. It will be decided by whether metal moves, whether contracts are honored, and whether incentives realign. Markets, in the end, respond to reality. Regulation can shape the path, but it cannot rewrite the destination.